My name is Josh Goodbody. I'm the Director of Growth and Institutional Business for Binance. I will be moderating today's wonderful panel. We're going to be talking about all things stablecoin related. So we have a pretty illustrious team here. We're going to try and ask some of the hard questions that some of you have asked us to ask them. But before we do that, I'm just going to kick off with some brief introductions. So Gustav, maybe you could start.
Yeah, so my name is Gustav Arentoft. I manage the European business at MakerDAO. So MakerDAO, we are the biggest decentralized stablecoin in the current market. We are an Ethereum-based project, and we do basically like an over-collateralized, credit-issued stablecoin. So we have quite a different model than, for example, Tether, centralized stablecoin. Yeah, I guess that's pretty much for like the brief, like general introduction.
Brilliant.
My name is Melikhov. I'm with the Equilibrium team. We are actually doing a lot of stuff in terms of DeFi. We're building the DeFi protocol called Equilibrium for accelerating the development of DeFi applications. We've rolled out the first components of this kind of protocol to the EOS blockchain. However, we consider ourselves as a multi-chain framework, which supposedly will embrace more assets within its ecosystem. The first proof of concept for the Equilibrium framework was the USDT stablecoin, which is the second biggest stablecoin on the market, decentralized ones, I mean, after MakerDAO. It's currently holding almost $15 million worth collateral on its smart contracts, which makes us one of the biggest dApps in terms of balance on the EOS blockchain. We are actually now looking at more expansion to other chains as well, so that's what's happening on our side.
Nice, thank you. Hi guys, I'm Vidal Arditi. I'm one of the new joiners to the team. I'm working on a Turkish stablecoin project for the last year. I'm the co-founder and COO. We're on the Ethereum network and one-to-one pegged, so we're an asset-backed stablecoin working in emerging markets and looking to capitalize on the interest in stablecoins and the use cases where we can add the most to the end users.
Super, thank you guys. Yeah. Okay, so I think it's fair to say in 2019 we saw a really massive interest develop across the year in the stablecoin space. We saw new issuers, we saw new service providers. It was a really active time in the market for us. Maybe Vidal, asking you, why do you think this happened in 2019? We went from a boom and a bust in 2017 on the asset side. 18 was a bit of a year of building. People were trying to take stock of where they are. 2019, we saw stablecoins go crazy. Why do you think that could be?
I think it was one of those pinnacle shifts where the market was expecting for adoption. People were using crypto for the first 5 to 10 years purely for speculation mostly, or looking into different financial assets that they can capitalize on. But once we crossed that 10-year mark after the founding of Bitcoin, I think that's when we first started getting new interest into the market and seeing new individual and institutional players looking in to get in, and stablecoins definitely proved to be the safest and easiest way to at least enter and exit these positions.
Yeah.
So I think that's one of the main reasons why we saw a huge increase in the adoption of stablecoins.
Cool. And so Gustav, then taking that and maybe narrowing down a little bit more on the use cases. In 2019, did you see more use cases develop for stablecoins?
Yeah, I mean, so I guess that like, of course we saw kind of like the rise of DeFi in general, especially in the Ethereum ecosystem, where we went from having around $300 million at early 2019 to reaching a bit over $1 billion, just here early 2020. So I think we saw like a lot of more use cases which focused a little bit more on like personal finance.
Right.
This is also the way that we see the space going on our end. I mean, previously we have seen Tether being exceptionally successful at the trading aspect, which previously whether you want to agree or not, was by far the biggest use case of crypto, right? We saw a lot of different applications being built, which from our perspective move more towards like personal finance, a little bit more of like a safe haven, like a safe harbor. And we also have seen, with the launch of our DAI savings rate in late 2019 in November, we now have around $60 million put into the DAI savings rate, earning around 8% per year. So this is like some of the things that we believe will really, incentivize people to start using stablecoins also outside of the crypto space.
Yeah.
I think also just in general, if you take kind of like the comparison to traditional fintech, you can see, for example, applications like Revolut or something like that deals with personal finance and spending. You can actually build those applications fairly easily right now in the crypto space by using, for example, Uniswap for trading. You can have the DAI savings rate or Compound for lending and borrowing and staking. You can do payments fairly easily, sending between your friends and so on. A good example of this is Argent, for example. So I think that like a lot of the building blocks to build these more like personal finance tools have actually been completed now, and then the composability of all the blocks makes it very easy for you to combine these things into new exciting products.
Interesting. So what we're saying is we've seen a clear shift from stablecoins just having one or two use cases being a nice fiat on-ramp or a nice connection to the fiat world in the trading space to actually having some pretty interesting retail use cases, powerful use cases, such as interest accruing products.
However, of course, compared to how big the trading use case still is, it's still like a much smaller market, but it's something that we definitely expect to be growing quite a lot in the upcoming years, right?
Super. So Alex, do you also share that view in terms of the stablecoins being pivoted a little bit for their use cases to face the retail market? And also, where do you think that's going to go this year?
Look, I think that's on top of these use cases for kind of personal finance. We saw the demand for stablecoins as private currencies for corporations as well, for some institutionals that are interested in getting into this space, having some convenient means of accounting, whatever. So we personally in Equilibrium have several requests from potential enterprises that are interested, potential enterprise customers who are interested in rolling out their own infrastructure with, it might be, by the way, just not running on, for example, public blockchains, but also can be rolled out to some private blockchains as well.
Right.
It's very much depending on which platforms you're actually looking at. So it's not necessarily that your stablecoin should be up and running on public blockchain like Ethereum or whatever blockchain that actually supports the on-chain logics, but it also can be rolled out to some private chains that use as the very convenient mean for accounting, for treasury management, for everything. So that's another applications of stablecoins and the existing technology that we see on the current market. Because we see that there are a lot of concepts that we have currently up and running and that actually prove their credibility. So among them, for sure, like decentralized stablecoins, and for sure the stablecoins that are backed by some more traditional assets. So I mean that's what's our perception of what's happening in this space.
Cool. So I would probably be slightly remiss if we didn't mention the elephant that's always in the room, Libra. 2019, we saw a massive amount of news about Libra. They changed their plan a number of times. They were slapped on the wrist by a number of different politicians or regulators. It's a bit of a mess in many ways. So Vidal, where do you think they are right now as a project? Do you think the Libra project is going to continue? Do you see it as a good thing where they currently are at, or is it actually dragging the rest of the stablecoin industry back?
So on a global perspective, when we look at it, Libra brought a lot of awareness that cryptocurrency and blockchain was missing on. So in those terms, I think that in terms of getting people to know more about cryptocurrencies and blockchain and the potential use cases for it, it was a huge plus. Seeing that they're facing a lot of regulatory issues in terms of deciding on the roadmap, deciding on which partners to do it with, and what type of technology to use and how to market it, I can see that they're having trouble with that, and they might continue to have trouble, but on the grander scale of things, I feel like Libra and alongside with that, Facebook in general, just because they can access 1.5, 2 billion people just as a firm, that brought a lot of attention to central banks, to regulators, to financial institutions that need to be in more talks with crypto projects and blockchains just in general to move forward and come up with a viable, sustainable solution in the stablecoin market.
Gotcha, yeah, okay. So I think it's fair to say that the situation that they've put themselves in is a bit messy, right?
Yeah.
But also imagine if you're launching like a crypto project and you go up before you're even finished building, and then you go to the regulator and you're like, this is what we're doing, regulators.
Yeah.
I mean, if Maker had done that with our model, that would also have been like a complete mess, especially if you try to get regulated in so many different jurisdictions all over the world, right?
Yeah, yeah. So it was a very almost backwards project.
Exactly.
They kind of came out and said, this is the idea we have.
Yeah.
What do you think, regulators? And they said, well, show us the detailed plans. Oh, you don't have the detailed plans.
Yeah.
So it was a very odd way to approach this actually pretty powerful and complicated subject, right?
Exactly.
They could have done a better job. But not wanting to put any of you on the spot, but I'm going to put you on the spot, Alex. What do you think the end state could look like for them? If they were to take the path of least resistance that would get them something that the regulator understands today, what do you think they could build this year that would maybe do that?
Let's maybe give a little bit overview of what they have been building first, because I guess maybe everyone knows. I just would remind you that they were starting with the basket of currencies that supposed to be backing the Libra stablecoin, and efficiently this model supposed to be competing with the existing banking system. That's why they got this mass in terms of its launch and this feedback from the regulators. And I guess currently they are switching their understanding of the current circumstances to from doing things and actually approaching the banked people to some unbanked audience in some developing countries. And I guess like what they currently are looking at, as from my understanding, they're looking at building some sort of local stable coins, which are actually pegged to local currencies, pretty much centralized, very much similar to those stable coins that we have currently on in our space, like USDC or Tether, whatever. So it would be a more centralized model with pegging to local currencies, and specifically targeting on developing countries, developing markets.
Interesting. Okay. So as you're building a model right now in Turkey, where do you see for your Turkish market the use cases that are easiest for clients? Is it very much a fiat-backed solution that people want to see, or is it something a little bit more complicated?
So it's a little bit more complicated just in the sense of marketing what we're doing in Turkey. There's two approaches. There's the usual individual who knows about blockchain or crypto and who's been trading beforehand. So they are just opting in to use us just because it's an easy on-ramp and off-ramp solution, which is cheap to use as well. But for a lot of people in the country right now, there's a lot of regulatory uncertainty, and they are still trying to understand what the technology is itself. So it's also part of this problem is trying to understand the missing part in the awareness problem and trying to fill that gap with educational tools and use cases. So right now we're mostly serving people for fiat on-ramps and their trades on both centralized and decentralized exchanges, but we definitely feel like the place and the use case that will be very competitive with traditional alternatives as well is going to be giving out interests or giving out loans, making everyday traditional financial instruments on the blockchain more accessible and easier to use with no limitations or obligations for the end user.
Gotcha. Okay, so taking a slight change of tack, Gustav, we've seen the Maker team, from its inception, build this Ethereum-backed model. You haven't deviated from that path. We'll talk about multi-collateral models a little bit later on. Where do you see the core strength in that model lying? Why, I suppose, is it something that we should all be extremely excited about?
So, I mean, I think the version of Maker and up until today, I mean, now we have BAT, the basic attention token, as well as collateral in the system. But like what you should see, the Ethereum, the only Ethereum backed DAI off was like a proof of concept, right?
Right.
Like what happens if we take liquid assets or assets that we have some capability of like selling off. We have, for example, like an auction system. We put them up as collateral and we use that to back basically an on-chain stablecoin in a decentralized manner with a governance system that supports this. So for the first 2 years, we kind of like call single collateral DAI the proof of concept. We proved that the model worked, even though the main collateral dropped with around 90% in value from the peak until like the bottom. So we have proved that the model works in that sense, but it's really not. It's not the future vision of what Maker is supposed to be, right? Or what Maker will be.
Right.
Like what we really perceive Maker to be is this like massive system where we have potentially hundreds of different collateral types, all backing DAI in different pegs. So we would not only have a dollar DAI, we'll also have a euro DAI,
right,
a Great British Pound DAI, and so on. And all of these DAI, they have the ability to claim part of the profits from the system via the DAI savings rate. So we actually right now distribute around 60% of the profits back to people holding DAI in the form of the DAI savings rate. So right now, if you hold DAI, we basically give the economic incentive that you can earn around 8% on it. And then the rest of the 40% of the system, the revenue of the system goes to the decentralized governance. So we as the Maker Foundation, the Maker team, we actually don't get any profit from the system. 100% of the profits gets redistributed back to the community. There's the DAI community and the Maker community.
Sure.
So like over time, we hope to be able to incentivize enough demand on the DAI side to basically be able to absorb the supply that we'll get from adding all of these very cool collateral types to the system.
Yeah.
So even though there's been a lot of hype around us, last year specifically with the launch of multi-collateral DAI and so on, kind of like where we see ourselves is just like in the beginning of the slope, right?
Yeah.
We believe that we are very far from where we want to be, and we believe there's so many more things to achieve. And we really just want to become this, like unbiased, truly unbiased alternative to the financial system, where everyone, no matter where you're based, have equal access and equal opportunity. That's really like our core values.
Great. I think the topic of multi-collateral backed stablecoins is definitely something that piques most people's interest, even people that tend to only use fiat-backed stablecoins. What they want to see, from what we've heard in the market when we've spoken to these people, is they want to see it work really well.
Yes.
And to work really well, it has to be as interoperable as it possibly can be across blockchains. That's one of the biggest challenges, I think, for most providers like yourselves in Equilibrium. So Alex, what are you guys doing on the multi-collateral side?
So firstly, we have rolled out the massive update for the system recently, just a couple of weeks ago. So according to this update, we have launched also the multi-collateral model for our system, but I guess it's, from technical perspective, it works slightly different to those things that actually Maker guys have on the table. So basically, it's we currently have the system which can be split into independent segments, which hold each of the segments will be holding particular collateral type. And these segments would be eventually independent in terms of its risk profile. So, and if some segment would fail for some reason, so for example, just I don't know, due to some extraordinary market events, right. If some I don't know whatever collateral will drop in its value so significantly that we should be forced to wind down the particular segment, the whole system will be remaining sustainable.
Right.
So that's a kind of our approach that we have taken in terms of multi-collateral things. So in other stuff, we also I wanted to remind you that we at Equilibrium, we have the stability fund, which we have established back in the end of last year. It's actually industry's first stability fund, which currently holds over $25 million, which ensures that users will get their funds back even if in case of some black swans events on the market. So that also like would add redundancy and stability to the system. And in terms of like multi-collateral things that are happening on our side, we are more looking at cross-chain interoperability things. We have started development of truly cross-chain system based on one of the kind of most awaited project that is going in production within 4 months, I guess, or something. It's a kind of it's actually Polkadot. So we have started developing on Polkadot, and we expect we will launch one of the first decentralized stablecoins there. And we actually we decided that if we go for different collateral types on different blockchains, we would not building the ecosystem chain by chain. We just wanted to build things at once, just to have the access to these chains which would be connected through bridges to Polkadot engine. So that's a kind of approach. And the main thing here that end user he will not be interacting with the Polkadot thing because this kind of technical setup will be hidden from end user. He will be interacting with the chains he used to interacting with, right? So with the chains he is actually holding his assets. So that's that's a kind of cross-chain stuff and multi-collateral approach that we have taken in Equilibrium.
Super. Okay. So we talked a little bit about multi-collateral models. You touched on, and maybe we'll touch on those in a bit more detail later, some of the inherent difficulties and complexities that arise when you do that. For your project, Vidal, what challenges did you meet when you were trying to build your end product? What were the key hurdles that you had to jump over while you were building?
Is there any difference between like technical, community? No, just in general.
Whatever you think, I guess, is the hot topic. Yeah.
Yeah. So, in general, thank God, crypto and blockchain has come to a place where we can go over certain technical details and certain technical hurdles. But mostly for us, it has been building a community and building an awareness around it, especially in emerging markets where these people are living these pain points on an everyday basis, daily lives. They can't transfer money, they can't exchange money, but they're not aware of blockchain or cryptocurrency yet. They don't know how much it can change their lives on a grander scale. So it's really incentivizing them to learn more about and participate in the community itself so that they can understand how much of a pain point that we're solving for them and the added benefits that they can get from an alternative financial vehicle rather than a traditional financial instrument.
Yeah, gotcha. Okay, so before we move on to our next subject, final question on this multi-collateral model. Hypothetically only, so if this was Cloud Cuckoo land, which asset type would you like to see compatible with a multi-asset stablecoin framework? Give you a minute to think. We'll start on this end. What would you love to see as part of
bonds?
Bonds.
Yeah, bonds.
Bonds as part of the
bonds is like one of the most incredible stable assets you can have.
Okay.
It's like easily priced debt.
Right.
It pays a dividend that you can often offset in the interest rate.
Yeah.
You can actually, for example, use a multi-collateral bond to raise, like multi-collateral vault, for example, in our case, you can actually use that to raise part of the bond. So let's say that you want to raise 100 million euros or something. You put like 10, 20 million euros into the open market, and then if you have a supply or like a demand for the stablecoin itself, you can have interest rates that actually will be cheaper than what the market will take in dividends. So you can actually use bonds, for example, as like a fundraising mechanism through like a multi-collateral vault-based system. So I think like bonds is like one of the things that we are very, very interested in. We have some really cool like projects that we hope to be able to come out with in like the next 4 to 12 months or something.
Yeah.
So I think bonds is probably one of the ones that I personally think is really interesting. If I had to pick one.
If you had to pick one, okay.
I could pick 3.
Good choice. Good choice. Okay, Alex.
My remark here that efficiently in DPoS systems, usually the DPoS systems stick to some sort of staking rewards mechanism. So efficiently, if you have some collateral types that actually presume staking rewards, like we have on EOS, for example, you efficiently can get some interest on staking just collateral into the system. So efficiently in USDT model, for example, we currently have negative interest rate because if user puts as a collateral EOS into our system, he gets roughly 2.4% a year just for staking. And since we got the APR currently around 1%, efficiently the APR for the end user is minus 1.4%. So it's just the remark regarding bonds.
So you just want to keep EOS as the only collateral? Is that what I'm taking here?
No, not exactly. I mean for sure. In terms of other collateral types, I think that unattended ecosystem on blockchain and crypto space, they definitely make sense. Bitcoin is very kind of anticipated collateral type. we at Equilibrium, by the way, like since we have rolled out this multi-collateral setup recently, we will be releasing with our partners Provable with their P tokens, the kind of update where we'll be able to offer to our users collateralizing Bitcoin for their system. So it would happen just within several 2-3 weeks, something like that. And
So you have Bitcoin as collateral?
yes. Exactly.
How are you bridging that?
So basically, P tokens, they're delivering the technology for wrapping Bitcoin on EOS blockchain, and we just will accept these wrap tokens as a collateral on our smart contracts.
And how do you see the security flaws of like bridges? Because this is like one of the big things, right?
They're backed by quite, eligible foundation. I mean, I know that major exchanges actually support P tokens in terms of like from on foundation side, federation. I'm sorry. So on federation side, and it seems like this setup would be quite robust.
So it's like a multi-sig foundation-based setup where you have like how many people holding the keys?
In part, so it's like proof of authority, right? So they are backing the project.
Sidechain.
But the thing is that they're having a quite sophisticated technical setup, which is executing cross-chain transactions. So actually, there is no validators on some third-party validators. All validations of cross-chain transactions are happening on some hardware they have developed within Provable, and this hardware actually guarantees that this transaction cannot be compromised.
Okay, well, if the hardware guarantees it,
Yeah, exactly. It's a hardware guarantee. So.
Okay, hardware guarantees.
Very nice. Okay. How about you?
And for the collateralized assets, what I would like to see is getting more traditional assets to be used as collateral. So stocks, real estate, I think gold even, that's something that's really interesting for emerging markets to be able to use what they already have as collateral and be able to join this new market as well.
Great. Okay. So maybe stepping back a bit, we've got about 10 minutes left or so. So let's talk a little bit about what you're doing this year. We've mentioned some of the multi-collateral stuff we're doing. What else are you guys up to this year?
So for example, I was in Paris last week at ETHCC, which is one of the big Ethereum community conferences, where there's like personally a project I'm very, very excited about. We're doing it with a local company called Shuttle One, a Singaporean-based company. And basically with them, we are taking the revenue of gig economy workers for a pretty big gig economy company in Indonesia, and using the revenue of the workers as collateral in our system to provide them with finance and closing the payment gap from between they get basically credit card payments from the customers, buying the services of the platform until they get basically the money released from the credit card company. So for example, this is like a case where we are doing like three different major things. So we are closing the payment gap. We are providing the gig economy workers with capital. So they, for example, they do grocery shopping. So when you're ordering your big Christmas dinner, this gig economy worker does not have the $100 in cash that you need him to have to pay for the goods. So basically, we are closing the payment gap of the platform. We are helping the gig economy workers with liquidity to purchase the goods so they can start working. And another thing is that 80% of the workers on this platform, they are unbanked when they start. So instead of unbanking them into a bank account, we basically unbank them into a digital wallet, where they'll be able to receive DAI payments. They can, of course, pay it to Indonesian rupee or phone credits, as well as giving them access to the DAI savings rate. So basically, as soon as they start earning money, we give them access to a pretty high interest rate on the money that they earn, and that way onboard them into a digital wallet. So that's, for example, one of the very, very real use cases that we are doing the first mainnet transactions next week with that one. The entire infrastructure is built out. However, since this collateral is not initially accepted in multi-collateral DAI, we are doing a more traditional financing of it.
Sure.
So basically, where we finance the setup out of a foundation, but hopefully eventually we'll be able to use this directly as collateral in the system, and thereby use Maker for the efficiency that we want to provide here. This is a platform where we provide both sides of the coin, right? We want to provide finance and liquidity through a collateralized real-world asset, and then on the other side, we distribute money out to the workers for basically creating DAI demand via the DAI savings rate.
Very interesting.
So that's, for example, one of the projects that I'm personally very excited about that coming out later this year, to mention one.
Sure. Okay. Brilliant. Thank you. Alex?
As I mentioned, one of the focuses which we have on our 2020 year's agenda is actually enterprises use cases. So as I said, we have several potential enterprise customers who are interested in building use cases with us, just adopting our technology to their business needs. And another thing that is quite important for us is actually building the more use cases for existing assets, for USDT and for the stablecoin that we have currently in our ecosystem. And like compared to MakerDAO, I guess there are a lot of developers around MakerDAO project that are building some their own projects on top of the MakerDAO's things. We unfortunately don't have that much developers that are actually building things around our ecosystem for now, and that's something which the gap we want to bridge within this year as well.
Okay, brilliant.
Nice. So one of the things that we're excited about is maybe getting the dollar dominance in the market into accruing in different emerging market currencies and assets. So Turkish lira was a start for us, and it's been going really well. We've got a lot of interest, and we've been talking with several more countries and governments in terms of enabling stablecoins in their own markets and in their own economy. So that's something that we're really interested about. And secondly, we've been really retail focused so far, and we've been serving a lot of individuals. But there's a high amount of businesses and institutions that are looking to use stablecoins as a part of their own infrastructure to make their own day-to-day lives a little bit more error-free or cost-free. So that's one of the things that we're going to be focusing on for the next year or two.
Great, thank you. How long have we got left, guys? 4 minutes, cool. Let's get some questions from the audience then. Let's see if anybody's feeling brave. We've got a guy in the front row. We're going to give you a microphone, just 1 second.
Okay,
I think we've got to put our headphones on, guys.
Oh. Remember to turn it on.
Question for
One
Gustav.
second, I think we've got to turn it. 1 second.
All right.
For Gustav.
Okay.
So what's the roadmap for the other stablecoin you mentioned, GBP DAO, Euro DAO, and also do you have use case in the remittance industry?
Cool.
Yeah. So we do quite a bit of stuff within the remittance space. I wouldn't say that like for stablecoins, I think in general we are still yet to see like a lot of the remittance use cases really manifesting themselves. But we do work with a lot of companies, specifically in South America. I think worth mentioning from like Mexico, for example, is Bitso, who is basically basically doing 2.5% of all the remittance between the US and Mexico. We are trying to grab like a bigger part of that market, and I would say like the use case of what we're doing there is that we will not just be like a settlement token, right? We'll actually be something where there's a pretty big incentive because of the interest rate on DAI to hold it after you receive it. So we want to be the currency that you not only just send back to your family, but your family will actually be able to hold, and they'll be able to actually retain value rather than just being like like an inflationary flat asset. So we do definitely have some stuff in the remittance space, but at the same time, right now, we are looking to scale up our market cap quite a bit in like the next year or two. So with that also comes much stronger liquidity. We recently closed some pretty big on and off ramps around the world. So for example, now DAI is available via WorldPay, who supports like 140 different countries. So we are still building out some of the stronger things around remittances, but it's definitely one of our focus areas, right? But right now, a lot of the stuff we do is like very like jurisdictional. In regards to the timeline for the Euro DAI and GBP DAI, later this year is all I can say right now. We want to make sure that when we launch, we have like complete confidence in also in regards to like regulation, for example, for our partners who will start integrating this DAI, the new DAI tokens. But later this year, yeah.
Super. I think we have time for a super short question. Anyone else feeling brave? Want to ask a question? One more
Just
question.
raise your hand if you have a question.
Go for it.
Thanks, everyone, guys. My question for Gustav as well. That specific example you gave of the gig economy and them being incentivized by giving them access to a wallet. what's the real value if they're, I'm just trying to think what the value is for them. If they're unbanked, what value is there for them to have access to the wallet, even though it has interest rate?
Okay, so I mean, so first off, just to be able to receive payments from the platform, they either need a bank account or a digital wallet, right? So like the first incentive for them to get onboarded is basically that we can provide them a digital wallet, which will give them access to similar services as if they had a bank account under the platform. So we are basically, instead of them having to go to a bank, fill out all of these documentation, so on, we are onboarding them basically with a 30-second download, and they need to be KYC to work on the platform, so this is already done directly in the app. And then the incentive for them to stay on the platform is the fact that if they hold their money in DAI on the platform, they receive 8% in interest rate per year. Whereas if they pay it out in cash, or if they pay it out in rupee, or just hold dollars, then they won't receive that interest rate. So we are very, very aware of the fact that this space is built on incentives, right? And if we're going to onboard people into using a stablecoin that they have no relationship with, and they don't necessarily care about, decentralization and DeFi and those things, giving them an economic incentive is definitely the way to go.
Okay.
All
I think
right.
that's probably what we have time for.
Yeah, thank you so much, guys. Thanks for listening. Big round of applause to the panelists. Thank you.
Thank you.